Good morning to all distinguished speakers, ladies and gentlemen. Today, we are starting the first session of our Sustainable and Inclusive Finance Forum for today. So we would like to provide some housekeeping rules. We'd like to request that everyone who is not speaking to please mute your microphone so as not to interrupt the current speaker. Our agenda for today, we were going to start with opening remarks from Datuk Sheikh Abdul Rashid Abdul Ghafur, Deputy Governor of Bank Negara. And then we will have opening remarks also from Hassan Zaman, Regional Director, East Asia and Pacific, Equitable Growth, Finance and Institutions for the World Bank Group, as followed by Dr. Bello Lawal Danbata, Secretary General of the Islamic Finance Services Board. We will then have a keynote address from Yang Berhormat Tuan Muhammad Sahar Abdullah, Deputy Finance Minister of the Ministry of Finance Malaysia. And then we'll have the launching of World Bank reports on Islamic finance, two different reports, Islamic finance and financial inclusion in Malaysia, and leveraging Islamic fintech to improve financial inclusion. We will then have a panel moderated by Abayomi Alawadi from the World Bank Group, with guest speakers Dr. Amir Rahman from the UNDP, Rafiuddin Shiko from Managing Director from Dinar Standard, and Dr. Rifki Ismail from the Islamic Financial Services Board. Following this, we would like now to invite Datuk Sheikh Abdul Rashid Abdul Ghafur, Deputy Governor of Bank Negara Malaysia, to provide his opening remarks. Dr. Rashid, please.
Thank you, Honorable Deputy Minister Tuan Muhammad Shahab bin Abdullah and fellow colleagues. Assalamualaikum and very good morning. Thank you for inviting me to speak at the launch of the World Bank reports on Islamic fintech and Islamic finance for inclusion in Malaysia. As countries continue to battle the coronavirus pandemic, the publication of these two important reports is a stark reminder that risk events such as the pandemic can significantly impact global growth and disproportionately affect those who are most vulnerable. The virus has claimed more than 1 million lives and infected more than 34 million people in more than 200 countries just within a span of 9 months. The World Bank Group estimated global economic activity to contract by 5.2% this year, with a triple hit on health, education, and income. This has serious ramifications to developments. The gathering today is therefore timely for us to exchange views and perspectives on concrete ways to build more equitable financial systems and the specific role that Islamic finance can play to catalyze an inclusive economic recovery. Over the past decade, the global financial community has seen commendable progress in advancing financial inclusion. The 2017 Global Findex database shows that about 70% of adults have an account compared to 51% in 2011. Yet, about 1.7 billion adults remain unbanked, with persistent inequality in account ownership between the rich and the poor. In recent months, new and unprecedented challenges to sustainability and effectiveness of financial inclusion initiatives worldwide have surfaced. Workers, especially in the formal sector and low-income segment, have experienced sudden loss of employment and income. Job replacement and reskilling programs require time to complete before these workers are able to gain new employment opportunities. The limited employment prospects and labor mobility, especially for low-skilled, low-income workers, may impede effective usage of financial services going forward. Containment measures, while necessary to control the spread of the virus, have also reduced accessibility to financial services. This is especially so in areas with poor digital connectivity and among communities with low digital financial literacy. From a human development standpoint, a United Nations Development Programme's report estimated that the combined impact of income, health, and education shocks arising from the pandemic could signify the largest reversal in human development on record, equivalent to erasing all the progress in human development of the past 6 years. The risk of reversing progress in achieving financial inclusion is accentuating why financial inclusion matters more now more than ever. Ladies and gentlemen, policy and regulatory responses across the globe and likewise in Malaysia have been focused on safeguarding economic resilience, managing risks to financial stability, and minimizing repercussions to society. This is done in tandem with the different stages of the pandemic, namely containment, stabilization, and recovery. At the onset of the crisis, governments, along with financial regulators, have deployed sizable stimulus packages and various assistance programs in order to contain the crisis and stabilize the economy. This includes addressing demand and supply disruptions, maintaining cash flows, and keeping workers employed. In Malaysia, for example, the total stimulus package amounted to 73.5 billion US dollars, with fiscal injection by the government totaling about 45 billion ringgit Malaysia. As of September 2020, a total of 2.63 million workers and 321,000 employers had benefited from the wage subsidy program, involving an expenditure of about 10.4 billion ringgit. To provide further stimulus to the economy, the central bank has reduced the overnight policy rate by a cumulative 125 basis points this year alone, alongside reduction in the statutory reserve requirement by 100 basis points. The reduction in the OPR is intended to provide additional policy stimulus to accelerate the pace of economic recovery. The financial industry, including Islamic financial institutions, also lend support to their borrowers and customers. In the first half of 2020, a total of 120 billion ringgit was disbursed in lending and financing to SMEs, with more accounts being approved in aggregate in 2020 compared to the same period in previous years. Islamic financial institutions and related associations have been actively educating and reaching out to affected borrowers about the financial assistance programs available in response to the pandemic. The takaful and insurance industry also facilitated affected certificate holders by offering temporary deferment of contribution and premium to promote continuity of takaful protection coverage. More than 1.1 million certificate and policyholders have benefited from this relief measure. While the pandemic has yet to peak in some countries, others, including Malaysia, are heading towards periods of recovery while continuously managing the risk of virus resurgence. As this phase commences, Islamic finance has significant potential and role to play. Three attributes at least come to mind on how Islamic finance can respond and contribute meaningfully towards sustainable and inclusive growth. The first attribute, Islamic finance must be value-driven and impact-focused to deliver the maqasid Sharia or the objective of Sharia. The intrinsic values of Islamic principles are aligned with the vision of economic growth that is balanced, sustainable, and inclusive. Sharia advocates for balance between wealth creation and wealth circulation. This is, in turn, promotes fairness and ihsan in promoting the attainment of benefits as well as preventing harm. The crisis has indeed created a wealth of opportunities for Islamic finance. Sharia contracts can deploy a diverse range of capital that is risk-absorbent, patient, and philanthropic in nature, using instruments such as risk-sharing, wakaf, and sadaqah to support inclusive finance. The flexible nature of such capital encourages allocation of resources towards entrepreneurial ventures and social impact projects that can improve and rebuild well-being of society. It can also, to some extent, help smoothen structural adjustments in the economy. Globally, we have seen a silver lining in the response to the pandemic. In Malaysia, for example, the nation has rallied closer together to become more socially conscious, not just in aspects of public health and welfare, but also in supporting the local economy. The Islamic financial institutions in Malaysia in particular have risen to the call to generate more positive impact through the value-based intimidation agenda. Participating Islamic financial institutions have endeavored to refine their products and services offerings in response to the need of their customers. 8 Islamic banking institutions, or about half the total number of Islamic banks in Malaysia, are offering microfinancing facility, utilizing the micro enterprise facility established by the central bank to increase access to finance for micro enterprises with viable businesses. In terms of financial protection, more than 50,000 participants have benefited from various micro-takaful products that provide affordable or free protection for the hardcore poor and individuals with special needs. Islamic financial institutions also continue to steward efforts towards building a greener financial system. In August 2020, the VBI Community of Practitioners, in collaboration with the Central Bank, issued 3 sectoral guides on energy efficiency, renewable energy, and palm oil for public consultation. The documents are intended to provide detailed guidance to the industry in embedding environmental, social, and governance risk considerations in the financing and investment decision-making process. Aligning corporate values with the objectives of promoting shared prosperity and sustainable growth is a critical first step to elevate the role of finance towards achieving inclusive growth. The second attribute is being technologically adept. Across the globe, digital divide remains a major roadblock in effective usage of financial services, especially in the rural areas with poor connectivity. While awareness of digital financial services has gradually increased, actual usage among low-income groups in Malaysia remains low. Among the key drivers to encourage greater adoption of digitally enabled financial services is simplicity and also user-friendliness. A well-designed solution which provides positive user experience can reduce mindset and technological barriers to the adoption and usage of digital financial services. For financial services providers, digital solutions have the benefit of reducing operational costs that may allow for more affordable products and wider access to the highly connected mobile phone and internet usage Malaysians population. Islamic finance can accelerate digital innovation through value-adding partnerships with the fintech community. During the pandemic, consumers and businesses alike have increased their use of mobile and digital platforms. Malaysia has a wide take-up of mobile banking technology, representing nearly 60% penetration rate to the total adult population. With increasing awareness of e-commerce amongst Malaysians, businesses have shifted their platforms or increased their presence on online marketplaces and utilization of e-payments. Several financial institutions have also even enhanced their internet and mobile banking channels to help market SME businesses amongst their customers. Takaful operators and insurance companies have also increased digitalization of their operations, such as claims processing and customer service, to minimize face-to-face interaction during the movement control order period. In August 2020, the bank collaborated with the Malaysian Digital Economy Corporation, MDEC, to launch the Fintech Booster Program. Fintech companies and their partners will gain access to tools and business development support, such as business model, legal, and compliance advisory to develop meaningful solutions. This program is expected to spur a more dynamic fintech ecosystem that can contribute to a thriving digital economy in Malaysia. Efforts to accelerate digital financial innovation can transform the way finance is delivered to society and expand its reach beyond traditional frontiers. The third attribute is being socially responsible in empowering the community. The infusion of social finance in Islamic financial services offers significant potential for Islamic finance to more effectively mobilize capital towards building social resilience. Provision of funds and financial protection can be made more affordable and accessible to a wider community by integrating social finance instruments such as endowment or wakaf, donation, and alms giving. We have seen countries such as Indonesia and Turkey have successfully integrated social finance within the broader financial ecosystem. To date, Islamic financial institutions in Malaysia have raised almost 9.7 million USD through wakaf and sedekah platforms to fund projects related to healthcare, education, and entrepreneurship. Social finance initiatives are implemented by leveraging on existing infrastructure, expertise, and accountability mechanisms within the Islamic financial sector. More than 10 different channels are available to enable collection and distribution of social finance funds, including via digital means of payment. More recently, a pilot blended financing program has been introduced to enable micro entrepreneurs in the low income group to generate more sustainable income from viable business activities. The provision of zakat funds as initial capital is complemented by affordable microfinancing arrangement for working capital. This is further supported with a customized training program to enhance business productivity. Participants on the program also receive 12 months of business mentoring with impact-based monitoring to monitor the effectiveness of the program. Ladies and gentlemen, in conclusion, the pandemic has been a test of resilience for nations around the world. This test also presents many opportunities for the global Islamic finance community to accelerate the progress of sustainable and inclusive finance towards achieving shared prosperity, sustainability, and inclusive growth. The launch of the two reports on Islamic fintech and Islamic finance for financial inclusion should be seen as a call for collective action. Each one of us has a part to play in creating a more sustainable and equitable financial system. I look forward to the discussion on this important topic over the course of today. On this note, I wish to thank the World Bank Group for this invitation, and I wish you all a productive week ahead. Thank you.
Thank you very much, Datuk Sheikh Abdul Rashid Abdul Ghafur from Bank Negara. Next up, I would like to invite Hassan Zaman, Regional Director, East Asia and the Pacific, Equitable Growth, Finance and Institutions of the World Bank Group, to give his opening remarks.
Distinguished Tuan Mohammed Shah bin Abdullah, Deputy Finance Minister to Ministry of Finance Malaysia, Dr. Sheikh Abdul Rashid bin Abdul Ghafur, Deputy Governor, Bank Negara Malaysia, Dr. Bello Lawal Danbata, Secretary General, Islamic Financial Services Board. Ladies and gentlemen, good morning and assalamu alaikum. It is my pleasure to give the opening remarks at this important session on maximizing Islamic finance for financial inclusion. Let me start by extending my gratitude to Bank Negara Malaysia for their support to our program in Malaysia and for their partnership in mounting this forum on sustainable and inclusive finance. Also, my thanks to IFSB for jointly organizing this session on Islamic finance. As part of the proceedings today, we are launching two reports produced under the auspices of the Malaysia Hub. First, the Islamic Finance and Financial Inclusion in Malaysia report, and secondly, the Leveraging Islamic Fintech to Improve Financial Inclusion. These studies are particularly relevant in these extraordinary times defined by the global COVID pandemic, where the access to financial services by lower income households and the ability to access these services in a contactless way is even more critical. As you all know, the pandemic has been devastating for economies across the globe. As the economic recovery begins in many countries, the financial sector will play a central role in supporting real sector activities. Naturally, Given the rapid growth of the industry in recent years, there is increased focus on the role of Islamic finance in responding to the COVID crisis, as well as its potential to support the post-COVID-19 recovery process. I will touch on 3 points today. Firstly, the potential of Islamic finance to support this response and recovery to the pandemic. Secondly, the role of financial sector authorities in this regard. And thirdly, the possible leveraging of Islamic fintech. On the first point, although Islamic finance is small relative to conventional finance, many countries now have sizable Islamic finance industries, for instance, in Malaysia, and there's been growing interest from other countries such as the United Kingdom and Luxembourg. As at end 2019, the size of the global Islamic finance industry was estimated at $2.4 trillion, following over a decade of double-digit growth. The bulk of industry assets are held in Islamic banks and sukuk assets, 72% and 32% respectively, with Islamic funds and takaful insurance making up the rest. The rapid growth of Islamic finance and the increased use of its financing instruments across jurisdictions has increased the potential of the industry to support COVID response and recovery through several channels, including by boosting investment in infrastructure and supporting micro, small, and medium-sized enterprises to foster job creation. In addition, the risk-sharing and asset-backing features of Islamic finance make it suitable for infrastructure projects with higher risk-return profiles, while the partnership and equity-style instruments are suitable for small businesses often struggling to get financing from other sources. The landmark issuance of the first green sukuk in Malaysia in 2017 demonstrated the potential of sukuk as an alternative fundraising and investment instrument, opening up an important new source of financing for development projects that have long gestation periods and require large capital outlays. Many of these activities will be critical to a sustained recovery from the COVID shock. As to maximizing financial inclusion, which is the topic for discussion today, Islamic finance offers several financing instruments to enterprises such as Mudaraba, Musharaka, and Ijara, which provide viable alternatives to those not comfortable with conventional debt-based financing on religious grounds. Other options include Sharia-compliant microfinance and microinsurance, takaful, which can be used to alleviate the impact of the shock on households and businesses. However, as clearly shown by the study on Islamic finance and financial inclusion in Malaysia, the successful use of Islamic finance to foster access to financial services requires a credible legal and regulatory framework, clear provisions for consumer protection, as well as sustained policy continuity and coordination between various stakeholders in the public and private sectors. Other countries striving to promote Islamic financial inclusion can benefit from these lessons of experience from Malaysia. Let me then turn to the role of financial sector authorities. It is really quite impressive to see that regulators and policymakers in Islamic finance jurisdictions have been active in fostering the use of Islamic finance for COVID response. Measures have been introduced to reduce the regulatory burden on Islamic banks through the temporary relaxation of capital and liquidity requirements, for instance, in Kuwait and Malaysia, the restructuring and rescheduling of refinancing facilities for Islamic banks, for instance, in Pakistan and the UAE, enhanced access to Sharia-compliant liquidity facilities at the central bank, for instance, in Kuwait, Malaysia, and Oman, and guarantees for SME borrowers, for instance, in Saudi Arabia. One interesting initiative, as was mentioned by Deputy Governor Mr. Ghafoor, is Malaysia's program to support the bottom 40 segment in generating sustainable income and achieve financial resilience, whereby Islamic social finance is combined, such as zakat, waqf, and sadaqah, provides the seed capital and is combined with microfinancing for eligible micro-entrepreneurs to start or grow their businesses. In addition to providing funding to micro-entrepreneurs, participating Islamic banks are also arranging structured training on entrepreneurship and financial management to ensure that their business owners run their ventures in a viable and sustainable manner. Let me move to my third point, which is on leveraging Islamic fintech. Across developing and emerging markets alike, the speed of innovation in digital financial services has been remarkable, giving rise to new business models, products, and distribution channels. In many countries, the scaling up of innovative digital approaches has enabled financial services to reach vast numbers of previously excluded and underserved households and small businesses. Fintech has also been instrumental in expanding financial access to women and women-owned businesses, particularly those in rural areas with limited physical presence of banking institutions. Digital financial services have become even more relevant during the physical distancing required by the pandemic outbreak, with its usefulness to transfer funds, pay bills, and receive government payments. A recent paper shows that the number of new users of digital financial services has gone up on average by about between 25 to 30% in a sample of 74 countries since the start of the pandemic. Not surprisingly, fintech in the Islamic finance industry has also expanded rapidly, with several examples of crowdsourcing platforms for micro entrepreneurs. For example, Liva from Jordan and Narwi from Qatar, property crowdfunding, for example, Ethis Malaysia, and payment services such as Pay Halal and Amal Pay, both also from Malaysia. Indeed, a key message of our study on leveraging Islamic fintech is that since the Muslim population is young and digitally savvy, there are significant opportunities to use digital technology to expand Islamic social finance, zakat, waqf, and sadaqah, as well as use distributed ledger technology to expand Islamic trade financing and reduce incidents of Sharia non-compliance. At the World Bank Group, we believe that a more sustained deployment of digital technology in the design and delivery of Islamic financial services holds great promise in expanding Islamic financial inclusion and in ensuring that the industry plays a central role in supporting the real sector. I'm looking forward to the discussion today on how Islamic finance can be a catalyst for financial inclusion and the role of fintech in that endeavor. I'm also glad to see that we will be discussing the role of regulators in fostering a suitable enabling environment for Islamic financial inclusion. This is critical because the expansion of Islamic financial inclusion must happen in a safe and responsible manner with appropriate legal, regulatory, and supervisory frameworks in place. In concluding, let me assure you that the World Bank Group continues to place a very high priority on mobilizing Islamic finance to support growth and development. Our thanks go to the Malaysian government and other counterparts for the valuable collaboration with the World Bank in this area. We truly value your support and look forward to expanding the agenda in the coming years. Thank you very much for giving me the opportunity to address this audience, and I wish you fruitful discussions during this session. Thank you very much.
Thank you very much, Hassan, for your remarks. Next up, I would like to invite Dr. Bello Lawal Danbata, Secretary General of the Islamic Financial Services Board, to give his opening remarks.
Bismillahirrahmanirrahim.
Dr. Bello, you are muted.
Bismillahirrahmanirrahim. Your Excellencies, distinguished panelists and participants, Assalamu alaikum wa rahmatullahi wa barakatuh. First of all, I would like to express my sincere appreciation and thanks to World Bank for inviting IFSB to collaborate in delivering this important session during their Sustainable and Inclusive Finance Forum. It is indeed my pleasure to deliver on opening remarks for this event. And on behalf of the Islamic Financial Services Board, I would like to first of all sincerely thank the World Bank and Bank Negara Malaysia, which is both esteemed members of the IFSB, for inviting us this year's launching of this important report. We are delighted to participate in this Sustainable and Inclusive Finance Forum to support the ongoing global efforts of inclusive finance using fintech and Islamic finance. I would like to express my sincere appreciation as well to the team that put all these efforts together and making it a successful event for us to be here today. Ladies and gentlemen, there is now a wealth of evidence from worldwide research that suggests financial inclusion plays a role in poverty reduction, reducing income disparities, and increasing economic growth. It is important for me, having had the first opening remarks from His Excellency Dr. Abdul Rashid Abdul Ghafoor and Dr. Hassan, for me to focus on financial inclusion and Islamic finance. If I may quote Ms. Christine Lagarde with regard to financial inclusion, when she was the president, when she was the MD of the IMF, she said that the merit of financial inclusion are strongly rooted in empowerment. Access to credit is a key link between economic opportunity and economic outcome. By empowering individuals and families to cultivate economic opportunities, financial inclusion can be a powerful agent for strong and inclusive growth. With this pandemic, in which the economic activities globally has fallen apart, it is important for all of us as stakeholders for the resilience and stability of the Islamic financial services industry and the global financial services industry to come together and have this important joint discussion to enable us come up with a better idea on how we can foster this agenda of inclusive finance. The positive development of financial inclusion, specifically in improving livelihoods of poor households and stimulating economic activity, and the economic and social cost of financial exclusion has been well theorized and in recent years has garnered a substantial empirical evidences. Now with the pandemic, it is important for all of us to look around and see how we can better up our economies and the resilience and stability of our financial institutions by tapping into the maximum opportunities that are available to us, particularly with regard to financial technology as well as financial inclusion opportunities. Ladies and gentlemen, financial inclusion is also of critical importance for the development and unity of our society. Let me briefly highlight some intriguing statistics, which we all remember. In 2010, the world has successfully achieved the first Millennium Development Goals target of reducing poverty by half since 1990. 5 years in advance, as the target was set to achieve by 2015, the target has so far been achieved in some aspects, but also lacking in some areas. However, poverty remains a challenge in the organizing of the Sustainable Development Goals agenda. The World Bank estimates yearly almost nearly 1 billion people still live below 1.25 US dollar per day, and almost 1/3 of this estimated to be in the OIC region, in which the IFSB is of great concern and interest in this region. 18 out of the 34 world lowest income group countries are from the OIC, accounting for almost 25% of the OIC population, while their contribution towards the total OIC GDP is merely 5.3%. Meanwhile, only 28% of the OIC population reportedly had an account in a financial institution as compared to 47% in other developing and 91.6% in developed countries. Financial inclusion remains a key challenge in the Middle East and North Africa and South Asia, as well as the Sub-Saharan Africa, which are home of large Muslim populations. Utilizing financing services from formal financial institutions remain low in these regions, while dependency on friends and family remains very high. These statistics are somber reality of the large extent of financial exclusion of the population from the formal financial sector in these regions. So why do we have such a trend in regions predominantly where we are underdeveloped? Among the various reasons proposed is religiosity is a critical factor that drives voluntary financial exclusion among Muslims jurisdiction in particular, because of the inherent prohibition of riba, and which makes them to avoid the current conventional financial system. The latest survey from the Gallup indicate that high levels of religiosity among the OIC countries. As a result, many Muslim households and micro, small, and medium enterprises voluntarily exclude themselves from the formal financial markets because of the religious requirements. That is the Islamic prohibition, as I mentioned, with regard to riba. So, for example, the World Bank's Global Financial Development Report highlights over 33 to 35%, almost the range of 33 to 35% of adults in Afghanistan had no formal bank accounts due to the religious reasons. In Tunisia and Morocco, the figure of adults with no formal bank accounts due to religious reasons stand at 26.8%. The statistics are identical across several countries, averaging above 20% in, for example, in Palestine, Iraq, Niger, Djibouti, Nigeria, Mauritania, Syria, and so on. To sum up, the scenario of having inclusive finance along with Islamic finance is a necessity. In this regard, the IFSB is not at far, but ahead of other international standard setting bodies, in the sense that we have last year, with the approval of our council, launched the first technical note on financial inclusion. This technical note is aimed to look at the opportunities as well as the prudential regulation that is necessarily needed to promote the development of financial services sector using the financial inclusion agenda, particularly using fintech, Islamic social finance, and other collective investments instruments. The accelerated digitalization due to the pandemic has now created an opportunity for us to revert and look seriously into the opportunities that is being provided by the Islamic finance. Islamic social finance is atop of the agenda of many member IFSB jurisdictions. For example, as highlighted by His Excellencies in his opening remarks, Indonesia and Malaysia has advanced in using both conventional and Islamic finance initiatives to support the development of finance and growth of the economy using the Islamic finance as well. Ladies and gentlemen, the situation warrants practical and innovative responses by the policymakers, regulators, market players, and other relevant stakeholders alike to ensure steady and sustainable development of the global economy. It is necessary for all of us during this pandemic time to come together and look at how Islamic social finance instruments like zakat, waqaf, and sadaqah can be used as a strategic economic recovery tool to support the recovery from the pandemic. It is important that the accelerated digital transformation has now given an opportunity for all of us to rethink and see how the Islamic financial instrument and services can be further structured to be in line with the digital transformation. The IFSB is one of the first, for many, as you are all aware, the IFSB is one of the first standard setting bodies globally to launch the full-fledged standards, as I mentioned earlier, on regulatory and supervisory guidelines specifically for financial inclusion. While various discussion papers and other types of guidance has been published by several international organizations and other bodies, a dedicated standard purely analyzing the specifics of financial inclusion is what I refer to as the IFSB Technical Note 3 on its financial inclusion and Islamic finance. In this regard, in my meetings with other Secretary Generals of standard setting bodies, including the conventional standard setting bodies, they have indicated much interest in awaiting the use and the application of these important technical notes that is being issued by the IFSB for them to be able to see how Islamic finance and financial inclusion can move the economies forward. In this regard, the IFSB is pleased also to announce a rigorous process that is being deployed in coming up with new initiatives and measures to support our member jurisdictions in managing and mitigating the impact of the COVID-19. The IFSB is ever determined to collaborate with World Bank and all its other stakeholders and members in furthering the development of Islamic finance as well as financial inclusion agenda. It is important at this point for me to highlight that the IFSB has, with the guidance of its council and other governance bodies, has come up with a number of initiatives to support the global Islamic financial services industry to mitigate and manage the potential negative impact of the pandemic. Through the issuance of public statements, we have come up with a number of research work as well as an analysis of the policy responses that has been issued by our respective member jurisdictions. It is on this note that I would like to highlight the importance of today's seminar or this discussion. I mean, that it is important for us to leverage on the expertise and the knowledge as well as the experience of the panelists to have a better idea on how to move the global Islamic financial services industry forward using the financial inclusion agenda. It is indeed our pleasure to continue to collaborate with World Bank in all its endeavors regarding the financial inclusion agenda. With this, I would like to thank once again the IFSB's member jurisdictions for their commendable efforts and initiatives that they have taken to address the potential impact of the pandemic, and as well to thank the World Bank and Bank Negara Malaysia for giving me the opportunity to speak and give an opening remark, even though everything has been open. So I just try to just look at what I can contribute in terms of the opening remarks by focusing on financial inclusion and Islamic finance. And I believe the discussion that will be following will help us to consolidate the better ideas and strategies for us to better use financial inclusion at the recent and post-pandemic times. With this, I want to once again thank you for your time and for listening to me. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much, Dr. Bello. Next up, we have the keynote address by YB Tuan Muhammad Shahar bin Abdullah, Deputy Finance Minister 2 of Malaysia, who will also be launching the World Bank reports on Islamic finance at the end of his keynote speech. YB, please.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh, and very good morning. Distinguished guests, Datuk Sheikh Abdul Rashid bin Abdul Ghafur, Deputy Governor of Bank Negara Malaysia, Hassan Zaman, Regional Director, East Asia and the Pacific, Equitable Growth Finance and Institutions, World Bank Group, Dr. Bello Lawal dan Balta, Secretary General, Islamic Financial Services Board, IFSB, ladies and gentlemen. I am pleased to deliver the keynote address at this important forum on maximizing financial inclusions. Let me start by extending my gratitude to Bank Negara Malaysia, the World Bank and IFSB for their continued efforts to deepen the Islamic finance markets and financial inclusions in Malaysia and the region. As highlighted in the World Bank report that we will launch today, Malaysia leadership in Islamic finance and financial inclusion has been fruitful. Several international indicators reflect Malaysia's achievement at the global stage. Malaysia accounts for 20% of global Islamic finance assets and maintains its position as jurisdictions with the largest volume of suku issuance at 36.8% of total suku outstanding in year 2019. Several factors that contributed to this achievement are Malaysia implemented a strategic initiative covering banking, takaful banking, takaful insurance, capital markets, and alternative finance have been marked by policy continuity and coordinations among different government ministries, departments, and agencies over a period of time. Ladies and gentlemen, these initiatives were complemented by Malaysia's comprehensive Islamic finance ecosystem, built with strong support from Bank Negara Malaysia and Security Commission Malaysia under their long-term plans, created a conducive business environment for Islamic finance to grow. Having an effective regulatory framework, initiative, human capital and talent development, rising awareness activities, and institutional investor support are key enablers in positioning Malaysia as a global hub. Additionally, the existing framework for Islamic social finance has been effectively leveraged in connecting wakaf, zakat, and sadaqah with financial institutions to enhance their reach and fund collection. There is no doubt that our strategies in deepening the Islamic finance markets has also contributed to Malaysia's high achievement in the global. Ladies and gentlemen, more than 85% of Malaysian population aged 15 and above have access to a financial account. This financial inclusion framework led by Bank Negara Malaysia with clear targeted action plan and accurate tracking of milestone has contributed significantly to the country high fintech score. In addition, the Security Commission Malaysia (SC) and Bursa Malaysia have helped to create a conducive business environment for micro and SMEs to access funding from capital market. Hospitable regulatory regime has been intrinsic to creating an effective ecosystem that promote financial inclusions and involve the Credit Guarantee Corporation, Credit Bureau, Consumer Protection Agency, and Deposit Insurance as some of its key components. Other institutions, let's say, gentlemen, such as Pemodalan Nasional Berhad and Tabung Haji also play a key role in advancing financial inclusion, especially in the rural area. For the new normal due to the COVID-19 pandemic has taught us to maximize digital financial services, including through Islamic financial instrument, through our initiative in a 6R strategy, the National Recovery Plan, Penjana, the government provide an incentive to encourage e-wallet account utilizations. Even the recent Sukuk Prihatin, which can cater to the retail investor, also can be subscribed via JomPay and Duit Now. The in the World Bank report also indicated that the vast majority of Malaysian adults have an account with a financial institution or use a mobile money service in the past 12 months. Despite Malaysia gains in the application of fintech, actually for ladies and gentlemen, fintech is quite close to my heart. Despite Malaysia gain in the application of fintechs towards financial inclusions, the government will consider reviewing its existing policy in addressing the issue highlighted in the report on bridging the technology gap between generations, SME readiness to adopt digital financial services, and developing the halal economy through digital platform. In conclusion, let me assure you that the government is committed to in ensuring each citizen, especially in Malaysia, to have equal opportunity to access financial services. We firmly believe that with all support given by Bank Negara Malaysia and SC, as well as international organizations such as the World Bank and IFSB, Malaysia can maintain its reputation as a global hub for Islamic finance. With that, I'm honored to launch the World Bank report on Islamic finance and financial inclusion in Malaysia and leveraging Islamic fintech to improve financial inclusion. Thank you, ladies and gentlemen. Thank you, the organizer, for allowing me to address this audience. I hope you find this session to be enlightening and informative. Thank you very much. To make the launch official, I will be holding the report so that the World Bank can take a photo. Have you done to take a photo for the officials?
Thank you, YB. Yes, we have taken the photo.
Thank you for the report.
Thank you very much, YB, to Muhammad Shahab, for launching our report. To our attendees, you can also scan the QR code to download the report. And now for our next event, we would like to invite the moderator, Mr. Abayomi Alawode, Lead Financial Sector Specialist and Head of Islamic Finance for the World Bank Group, to launch the panel discussion.
Thank you, Rosani. Can everybody hear and see?
Yes, Yomi, we can hear you.
All right, thank you. Welcome again to all distinguished participants and to all the speakers who have joined us today to discuss this topic of how to maximize Islamic finance for financial inclusion. My name is Abayomi Alawode. I'm a lead financial sector specialist with the World Bank, and I also head the Islamic finance program. With us today, we have 3 speakers, and I will not go into details on their bios. You do have their bios. The first speaker is Dr. Amir Rahman, who is a senior advisor with the United Nations Development Program. Some of you may know him. He's a frequent speaker at World Bank Islamic Finance events and has participated in some of our webinars before. Welcome, Amir. Next, we have Rafiuddin Shiko, who is Managing Director of Dinar Standard based in Dubai. He's an expert on Islamic fintech, and he has also shared with us in the past his expertise on this topic, and we're glad to have him join us today, although it's very early hours in Dubai at this time. Thank you very much for joining us, Rafi. And last but not the least, we have Dr. Rifki Ismail, who is the Assistant Secretary General of IFSB for Standards and Research. And he's also a member of the National Sharia Board in Indonesia, so it brings a particularly interesting perspective to the field of Islamic finance. But today he's going to be wearing his regulatory hat and will be talking to us about the role of regulators in promoting Islamic financial inclusion. So with that, let me go straight to Amir, who is going to share with us some thoughts on how Islamic finance can be a catalyst for financial inclusion. And on this topic, he has a particularly interesting vantage point as one of the co-authors of the report that was just launched. So Amir, the floor is yours.
Thank you so much, Yomi. Distinguished speakers, honorable dignitaries, and co-panelists, it's my distinct pleasure to join you in discussing the launch of this report, sharing some of its highlights, and emphasizing the importance of this work for the international development community, as well as the Islamic finance community. So I'll take a few minutes to share with you highlights of this report and also why it matters so centrally, as was eloquently highlighted by in the opening remarks, that given the role of Islamic finance in general, as well as in this time of COVID response and recovery. And so if we go to the next slide in the presentation, what I'll plan to do in the time allotted is to discuss first and foremost the importance of the report, and then highlight Malaysia's success in financial inclusion and Islamic finance. And as we've begun to hear, and as the report certainly substantiates, Malaysia indeed has much success in these two areas, financial inclusion and Islamic finance. And this report provides data to underscore both of those areas and look at the relationship between those two very important developments. So the financial inclusion, as well as the development of the Islamic finance sector. We'll speak a bit about regulatory foundations, and of course, Dr. Rifki can say much more as a direct practitioner from a regulatory perspective. We'll speak a bit about institutional enablers of Islamic finance inclusion in Malaysia. And we'll speak finally more broadly from a global development perspective, what lessons can be taken from this report and from the Malaysian example and applied elsewhere. And perhaps that will be of use and benefit to many of our attendees who are looking to replicate this model of success. If we move to the next slide, the report that was developed here by the World Bank Group with partnership with Bank Negara and with much support from the community was looking at the role of Islamic finance in furthering financial inclusion in Malaysia. And as you can see, the interplay, one of the key findings that we saw is that there is an interplay that was in fact in two ways. So certainly Islamic finance, we see Islamic finance contributing to financial inclusion. And there have already been some very good comments made in the session today regarding how conceptually Islamic finance removes religious barriers, brings more people into the formal financial system, gives access to credit to those who would not have it, so on and so forth. And the study looked at this in detail and quantified some of this impact, but also the role of financial inclusion strategies in supporting Islamic finance. Because as more of the population in Malaysia had access to financial services, their preference for Islamic finance manifested, and that also contributed to the growth of Islamic finance. So one of the insights of the report is that there's a role of Islamic finance in supporting financial inclusion, and there's also a role of financial inclusion in supporting the Islamic finance sector. So this was an interplay that was observed. And the report itself largely at the World Bank Findex, the Financial Inclusion Index, which is a global database. It also looked at some of the regulatory and policy frameworks that have been put into place in Malaysia, looked at the important institutional enablers, which I'll be touching on, as well as consumer and investor protection, which was rightly highlighted in the beginning of the conversation today, and digital finance, which Brother Rafiuddin will speak of in much more detail. But certainly suffices to say that the role of digital finance in financial inclusion was important and has been seen as quite central, both for conventional and Islamic finance. Next slide, please. The study was, of course, done through collaboration. The slide here provides you the names of the teams that were involved in producing the report under the leadership of Abayomi Alawode. There was a team of authors. There was input from various sources within the World Bank and various experts, and of course, from the senior executives in the World Bank. And the result was the report that His Excellency, the Minister, was showing you just now. So congratulations to all involved in the study. Next slide. The report, from my perspective, and I would say from an international development community perspective, makes contributions in at least three important areas. One is in understanding Malaysia's national development. So, of course, Malaysia has invested and made some very important policy choices over the past several decades to support Islamic finance as a means of financial inclusion. So part of what the report does is understand and document in what ways those policy choices have indeed resulted in successful financial inclusion in Malaysia. And so from a Malaysian development perspective, it is hoped that this report makes a contribution. So that's one area. Second is in the field of financial inclusion. This report certainly provides analysis and examples that seek to enhance financial inclusion through the removal of religious barriers. As Dr. Bello was referring to, religious barriers do exist. One of the interesting data points you'll find in the report is that religious barriers to financial inclusion are not specific to Muslims. And so the Findex database asks questions regarding barriers to inclusion in finance and why people choose not to participate in the financial sector. And we find that in countries where there are where the predominant religion is other than Islam and where Muslims are very few, we nonetheless see significant segments of the population facing religious barriers or citing religious barriers. So two countries, as you can see here, Botswana and Peru, are countries in which between 8 and 9% of the population cite religious reasons as a reason for not having a financial account. So, as faith-neutral institutions, as we are at the United Nations and, of course, the World Bank and our other colleagues in the international development system, this is a very important thing to understand that knowing how religious barriers is beneficial not only in Muslim majority contexts, but also other contexts where faith is a reason why people are uncomfortable with the conventional financial system. And so this is an important contribution. The report is an important contribution not only to Muslim majority countries, but also the world more broadly. And finally, with respect to Islamic finance, it helps highlight the complementarity between financial inclusion and Islamic finance. And as I was mentioning earlier, just as Islamic finance has played a role in supporting financial inclusion, we also see that the financial inclusion efforts of Malaysia more broadly have been supportive of Islamic finance. Next slide. Next slide. So when the report looked at Malaysia's success in financial inclusion, and some of these statistics have already been cited in the opening remarks, and what we see is Malaysia has been a clear success in financial inclusion, and the report looked at Malaysia in comparison to three different peer groups. So one of the peer groups was the ASEAN region, of which, of course, Malaysia is a member. The second peer group was the OIC, so the Organization of Islamic Conference or Islamic Cooperation, of which, of course, Malaysia is a member. And then also the upper middle income countries bracket, which is a classification within the World Bank's classifications of development peer groups. And so what was found is that consistently across the 3 different peer groups, Malaysia performed very strongly. In fact, across the 8 metrics which were focused on in the study, Malaysia was never below the top third in terms of compared to its peer groups. And in certain metrics, it was at the very top of the list. So for instance, Malaysia led all OIC countries in having members of the financial institutions. So Malaysia was top amongst all OIC countries for having savings in institutions. And in fact, as we get into the examples, it becomes quite evident how Islamic finance has played a role in that. Malaysia was above the 80th percentile amongst ASEAN countries on 6 of the 8 metrics. And then amongst the upper middle income countries globally, Malaysia was never below the top third. So again, amongst its peer countries, so not globally, but looking more focused at a peer group, we find that Malaysia did very well, has done very well on financial inclusion. In particular, I would highlight that access to accounts, access to savings, saving at institutions, and using cards. These were areas where Malaysia performed particularly well compared to its peers. And from a development perspective, it's noteworthy because often when we think about the growth of the financial sector, we focus on credit and access to credit, which has certainly very important benefits for allowing people to build enterprises and the like. But one of the highlights of Malaysia is that it has not only provided access to credit, but also access to savings and investments. And that has been beneficial to the population in terms of building wealth in the community. Next slide. Malaysia's leadership in Islamic finance is well known to this group. There's some of the metrics that support that. You can see that Malaysia ranks #1 in terms of the Sukuk market. It's #1 in terms of the number of financial institutions and the like, #2 with funds and so on and so forth. So Malaysia has a very strong leadership position globally when it comes to Islamic finance. And this is, of course, well known amongst Islamic finance experts. We also see the institutions, including IFSB, as we've heard from Dr. Bello, the Islamic Liquidity Management Corporation, INSEF, ISRA. So there has been a concerted effort over the years to bring and establish in Malaysia institutions that serve Islamic finance broadly, and that has cemented Malaysia's position as a leader in Islamic finance. So we see, as was on the previous slide, Malaysia as a leader in financial inclusion, and also Malaysia as a leader in Islamic finance. Next slide, please. This slide is very important in understanding the Malaysia's success in removing religious barriers to financial participation. Indeed, a large rationale for which, or the reason why international development institutions have engaged with Islamic finance is to remove religious barriers to financial participation. And Malaysia has done very well in this, not only in absolute terms, but also relative to other OIC countries. And so you can see here that in Malaysia, about 1.5%, 1.6% of the population cites religious reasons being the basis for them not being included in the financial system. And as was cited earlier, 85% of the population have accounts at financial institutions. So when we do the analysis looking at the 15% who do not have are not part of the formal system, and we try to understand what their reasons are, only 1.6% of the population settle on the reason of religious barriers. And this is very significant. Now, of course, from a Malaysian development perspective, one would like to see this reduced even further. And we see some countries that have managed to reduce this even further down to, for example, 0.5% in Kuwait. But nonetheless, it is a remarkable feat to the extent to which religion as a barrier to participation has been removed in Malaysia. It's also, from a global development perspective, when we look at some of the large population Muslim majority countries such as Pakistan, Turkey, Egypt, Indonesia, all of these have significantly higher percentages of non-participation religious reasons. And of course, in absolute terms, that translates to very large numbers of households. Next slide, please. Next, we move on to discuss some of the regulatory foundations that have allowed Malaysia to be successful in these two areas, financial inclusion as well as Islamic finance. And next slide. So Malaysia has had a very comprehensive policy framework for financial inclusion. This in the financial sector blueprint for the years 2011 to 2020, there was a financial inclusion framework. It's very precise. Of course, it's in the report and available elsewhere. We commend Bank Negara Malaysia for the robustness with which this was prepared. It has 4 desired outcomes. It has 4 broad strategies, 10 action plans. It has metrics and KPIs, and they are very clear and precise in terms of the measurements of progress on the goal towards financial inclusion. Next slide. Similarly, the framework for Islamic finance is very well integrated in Malaysia. And the Islamic Financial Services Act of 2013 is one example of the regulation and how it has been integrated across the various regulators and stakeholders in Malaysia. There is a concerted and joint up effort between Bank Negara Malaysia, the Securities Commission, Labuan Financial Services Authority, and other stakeholders in Malaysia to have a coordinated policy around Islamic financial regulation. And that has been very, very supportive and beneficial to Islamic finance. When we look at other countries that have Islamic finance sectors but have not developed them as strongly, an integrated policy framework is often lacking. In Malaysia, the policy framework is present, it's very robust, it's very clear, it's very strong, and this is cited in the report as being one of the key reasons why there has been success in Islamic finance in Malaysia. Next slide. Islamic social finance has come up a number of times in the discussion, and Malaysia has taken important steps to regulate and to govern Islamic social finance. There is a combination of regulation at the state level. So there, historically and traditionally, the states in Malaysia have regulated and overseen zakat and awqaf and other forms of Islamic social finance. In recent times, there have been more federal measures to coordinate the frameworks and coordinate the Islamic social finance development across all the states of Malaysia. And the Securities Commission Malaysia has included Waqf assets, as was cited earlier by His Excellency the Deputy Governor. There is within the Securities Commission of Malaysia framework, Waqf assets are considered part of the socially responsible investing framework. And there are issuances in play. There are ways in which awqaf assets can be financed through the capital markets. And this is a very important innovation. It's very noteworthy, and it's a way in which, again, Malaysia is taking a lead globally for Islamic finance supervision, and that's leading to financial inclusion and leading to a robust Islamic finance sector. Next slide. The institutional labors, I'll run through this briefly to highlight a few of the institutions, and more can be found in the report itself. Next slide. Tabung Haji has been a very important institution for fostering and inclusion and encouraging savings. Remember the data we cited earlier regarding the role of the leadership of Malaysia in terms of saving at institutions. Well, when we look at Tabung Haji and its legacy, you can see the link between the two. So you can see how Tabung Haji's existence since 1963, its role in promoting savings for pilgrimage purposes at the beginning, but now more broadly promoting savings across the population, has led to financial participation in a very real and concrete way. Not only, as you see on the left, have its assets grown exponentially, but also Tabung Haji has provided very strong and attractive returns to savers. So when we think about promoting financial inclusion, it's important not only that the vehicles exist for members of the population who have religious concerns to be able to invest, but also that those investments should perform well. And that's been the case with Tabung Haji. Next slide. PNB was established in 1978 to increase economic participation. And indeed, it has had over the decades a very meaningful role in sharing prosperity reducing inequalities, providing access to ownership of assets amongst members of the population which were previously excluded or previously underrepresented. And so that has been one major success of PNB. Another success is promoting long-term saving and investing, which has been beneficial to the Malaysian economy overall. So we can see the massive growth of PNB's assets under management, and we can also see the strategic impact that it's had. Next slide. Finally, I'll close with some thoughts on implications for development and look forward to hearing from our colleagues and having a conversation with the attendees. What can be learned from Malaysia's example with regards to promoting financial inclusion, enabling financial inclusion, and also enabling Islamic finance? A first key lesson is the need for integrated policy frameworks. So we see that Bank Negara Malaysia, Securities Commission Malaysia, the government of Malaysia, various parties in the country have played a role in integrating policy frameworks, having all stakeholders aligned on that. And those policy frameworks have existed for Islamic finance as well as for financial inclusion. And so that is that we as the United Nations Development Program and certainly across the international community see as a very important lesson from this report. And we thank the World Bank for highlighting this, the benefits of an integrated policy framework. So that's one which is very essential. Second, the institutional enablers. I've spoken about only a couple of them. There's Tabung Haji, there's PNB, also FELDA, which was very important for land ownership, and other institutional measures. So we've seen policy frameworks in place. We've seen institutional and labor enablers to move forward in terms of economic activity governed by those frameworks. And then finally, the point of removing religious barriers is fundamentally important. So Malaysia has been extremely successful in removing religious barriers, and that has led to a thriving financial sector. And the efforts to make the financial sector more inclusive have also in turn supported the development of Islamic finance. So we see that this report is relevant not only to Malaysia, but also to countries around the world who would like to replicate its success. And with that, I'll close my comments, Yomi, and we'll hear from our colleagues on the panel.
Thank you, Amir, for going through some of the key takeaways from the report. Although I have a conflict of interest, but I'll still like to highlight some of the points that you made about religion being a barrier to financial access or inclusion in other countries, and the fact that people often focus on credit, but we found that access to savings is actually one of the key gateways into broader access to other financial services. And you also mentioned the fact that Malaysia produced this blueprint or master plan. And I think I've mentioned this in the past, that Malaysia is a leader in terms of master plans and blueprints and implementation roadmaps. And I think this comes out clearly in the area of financial inclusion as to how you can put together a coherent framework and consistent policy approach to make sure that you implement some of these policy initiatives that came up through the Malaysian policymakers' deliberations. And finally, you pointed out the institutional environment, which is also important, and the fact that entities like Tabung Haji and PNB were instrumental in pushing this agenda forward. And I think the hope here is that other countries that are trying to do what Malaysia has done can learn from some of these experiences. Of course, it's not copy and paste. We have to make adjustments to take account of individual country circumstances. But some of these lessons can be broadly applied in other countries as well. So with that, let's move to the next speaker, Rafi, who's going to talk about fintech. As you've heard from some of the keynote speakers, this has become particularly important under this COVID pandemic, where social distancing has become the norm. So now is the time when the use of digital financial services has become top of the agenda. So Rafi will now share with us some of his insights on this topic. And he also was a principal author of the report on leveraging Islamic fintech for financial inclusion. So he also has particular insights on that. Rafi, the floor is yours.
Thank you so much. Assalamu alaikum. Your Excellencies, Datuk Sheikh Abdul Rashid bin Abdul Ghafoor, Mr. Hassan Zaman, Dr. Bello Lawal Din Bata, Tuan Muhammad Shahar bin Abdullah, Your Excellencies, distinguished panelists and attendees. It's a pleasure and honor to be sharing the insights from this report, Leveraging Islamic FinTech to Improve Financial Inclusion. As we all know, Islamic finance is a fast-growing segment of global finance, serving a core population of 1.8 billion Muslims worldwide and a wider global ethical finance audience with its appeal. Its role is growing in global significance, especially as it relates to global social financing needs. The global fintech revolution is having a similar impact for Islamic finance through the evolution of a nascent Islamic fintech ecosystem. So the purpose of this report, ladies and gentlemen, was to evaluate the global developments in the area of fintech solutions by Islamic financial institutions and its impact on financial inclusion within its core markets. Before I begin, I'd like to thank, obviously, as Mr. Amir Rahman mentioned about the previous report produced by World Bank, this report is also an effort by a team led by Mr. Al-Waoud Yomi, myself, but additional input from Mr. Ahmed Hafiz bin Abdulaziz, Muhammad Ruzani bin Muhammad Usman, Rekha Reddy, and Wei Zhang. And the team has worked under the overall guidance of Mr. Hassan Zaman, and Cecile Thiero Nian, as well as Irina Astrakhan and Firas Raj. So collectively, congratulations to everyone for the launch of this important report as well, and it's an honor to be part of this team. The way the report is structured, ladies and gentlemen, essentially it begins with an overview of fintech worldwide in general, just to put the context around how the global developments of fintech are being benchmarked to its application or utilization in Islamic finance in general. And then we go into covering specifically the Islamic fintech ecosystem landscape. As I said, it's a nascent area. And so we identify the activity and the areas and some of the case studies. We then talk about Islamic fintech's role in financial inclusion. And then finally, share with you insights on roadmap, challenges, opportunities that this space provides. So with this, if I can ask to move to the next slide. Now, in terms of, before we talk about Islamic fintech and financial inclusion, it's important to frame the context and have a clear view of what is fintech vis-a-vis the report's consideration. The report acknowledges that the fact that within this century, technology and automation have always been a key part of the global financial services industry. Bank mainframe computer networks, ATMs, digital stock exchanges are examples of the earlier financial services technologies. So the advent of the recent fintech revolution, however, is a unique manifestation or advancement that is resulting in a disruptive change of the financial services industry led by a new breed of technology enablers. And keeping this in mind, we have essentially focused on the coverage of fintech, and as also widely being acknowledged in the global fintech landscape, you can see in this chart, defined those technologies as articulated by Klaus Schwab, the founder, executive chairman of World Economic Forum, referring to the fourth industrial revolution technology. So we are looking at fintech as fourth industrial revolution driven technologies that are exponentially enhancing and or disrupting 20th century banking services, operations, business models, and customer engagement. So with this context of what we are looking at, essentially this report covers 9 core driving fintech technologies that are delivering key end customer financial services, as well as back office operational support and efficiencies. And these 9 technologies, I can see artificial intelligence as core underlying, big data analytics, quantum computing, mobility, open banking, P2P finance, blockchain, cloud adoption, and cybersecurity. So with this, the next slide, if we could go to, please. The report also summarizes the key fintech global trends that are shaping as of today, starting from the fact that there is continues to be, even in a COVID and this pandemic era, a strong growth in investment attraction towards fintech solutions. There is innovation in specific service areas and consolidation in the payment sectors. There's consolidation with incumbent banks to innovate banking technology. So it's no more just fintech as startups or standalone, but in consolidation with incumbents, as well as expansion to other areas of retail services that are also incorporating fintech in their proposition. So we identified 9 areas, and I just wanted to briefly highlight these, and they're elaborated further in the report as well. So if we can move on now, with this broader context of the global fintech landscape, let's go into Islamic finance and fintech. As articulated by the esteemed speakers and presenters earlier, Islamic finance, as we all know, is a fast-growing segment of global finance. Across the OIC or the core Islamic finance markets, as we heard in terms of Malaysia as being one of the leaders, to many of the other core markets around the world, the assets today look at, or as per 2018, as per this definitive report, around 2.5 trillion and growing to 3.5 trillion. And it's within this context of Islamic finance that we're looking at how fintech in general is first of all playing a role. So similar to fintech's role in global finance, fintech is also obviously playing a role in the development of Islamic finance, with all of its key subsegments as highlighted here, from Islamic banking, capital markets, insurance, takaful, and other Islamic financial core categories. So if we move on to the next slide. However, while we've been seeing and experiencing double-digit growth in the past decade, Islamic finance in many markets is struggling with maintaining those double-digit growth, and we're looking in most places single-digit growth even pre the pandemic, and so the growth of Islamic finance itself is being challenged. And here we are looking at where within OIC member countries, for example, putting the context of financial inclusion, in 2018, 41% of OIC member countries, which are the mostly Muslim majority, 57 countries around the world, had significantly 41% of the OIC countries had account ownership at 41%, as I said, compared to high income countries where it was 92%. So, and in addition to this, the reason we heard previously, as Mr. Amir Rahman and others have highlighted, the reason for not having an account where religion has played a role is 5%, which is much higher in the case of OIC member countries relative to the rest of the world, indicating a strong role for Islamic finance and fintech in addressing this gap. So as we go into the role of Islamic fintech, one of the key drivers of Islamic fintech within Islamic finance is the fact that the demographic within Muslim populations worldwide today comprises of more than half of the global population that is under 34 years old. This young demographic is highly tech savvy, with source markets having high mobile and internet penetration relative to global average. Again, further detailed out in the report, which speaks to the importance and relevance of Islamic fintech. So if we go on to the next slide, please. In the report, we highlight, first of all, broadly the Islamic fintech ecosystem that's developing, touching on various players that are offering funding solutions, that are providing financing solutions such as crowdfunding platform Ethis Crowd or Pay Halal, which is based in Malaysia, or as well as the investment accounts platform that's been set up by the regulatory ecosystem here in Malaysia. Capital market solutions, wealth management solutions are quite popular, and we'll touch upon that a bit as well. And the other area to highlight as well is Islamic social finance. So we heard earlier also the growing role and importance of Islamic social finance pool from zakat, which is obligatory charity, or sadaqah, voluntary charity, and waqf, or Islamic endowments. Zakat itself, we see a potential contribution of $200 billion to $1 trillion globally towards poverty alleviation, according to UNDP in 2018. So certainly the role of fintech in not just addressing core financial services, but social finance is increasingly becoming prominent. So we move on to the next slide. Based on a study done by Dinar Standard in 2008, as of 2018, there were 98 fintech, core fintech propositions that were customer facing, not infrastructure related, but customer facing, that were highlighted. And since then, there's been further developments, but this report covers the segmentation of those 98 core financial fintech, Islamic fintech solutions that are out there. And you can see in terms of the breakdown of classification by financial services, by the technology categories, and by geography. In terms of geography, as you can see, a strong momentum in Indonesia, followed by US, UAE, UK, Malaysia, and others. And when it comes to technologies, we see P2P finance and general financing and wealth management as a major area of existing Islamic fintech solutions. Like I said, most of these players are still in the infancy, early years, and since 2018, we've seen continue to see tremendous growth in them, as well as the adoption by the incumbent or the established financial institutions. So we can go to the next slide. Obviously, an important part in the development of Islamic fintech landscape is the regulatory and the regulatory infrastructure to facilitate Islamic fintech. And the major Islamic finance jurisdictions, led by Malaysia indeed, as well as now increasingly by Indonesia, UAE, Bahrain, even UK, Turkey, and Abu Dhabi, are offering strong platforms, ecosystems, regulatory sandboxes to enable the innovations to develop through Islamic fintech solutions. And again, this is detailed out in the report. Next slide, please. So before we cover case studies and specific examples of Islamic fintech and financial inclusion, select case studies are highlighted in showing the some of the key players in Islamic fintech. We highlight Hello Gold, which is an wealth management Islamic fintech. We also highlight Wahid as a case study, which is a Sharia compliant robo advisory platform, and Beehive, which is Middle East, North Africa region's first regulated P2P lending platform that is also has a Sharia compliant proposition. So we move on to the next one. Next slide, please. So now, as we go into financial inclusion as the area of focus, first of all, acknowledging that financial inclusion as a definition means financial inclusion is measured by the access to financial services by all sectors of society at an affordable cost. This includes bank accounts, affordable credit, insurance, payments, and trade transactions. Now, within the context of Islamic fintech, the population of unbanked people around the world is interestingly incidentally dominated by Muslim populated countries. So out of the world's population of 7.6 billion, the World Bank estimates that there are 1.7 billion unbanked retail customers and more than 200 million mid to small medium enterprises. And the unbanked population is dominated by Muslim populated countries, as I mentioned, with almost 50% of the world's unbanked population in these countries, whereas the potential of revenue in tapping the unbanked retail and MSME market is estimated to be 200 billion. So that also has a key significant portion within the Muslim majority countries. So if you can move on to the next slide, please. The report, as mentioned, Islamic fintech is still very much in its infancy. And when we looked at in the report to cover global best practices and benchmarks on financial inclusion, we highlighted and various fintech solutions that worldwide are mapping or addressing the SDG goals that have been set. And so we shared some of those examples as a reference point for the development of Islamic fintech to look at some of these areas that are not necessarily being covered today by Islamic fintech. So for example, to touch on some of the examples highlighted here in the slide, but detailed out in the report, Bolsa Familiar is a fintech from Brazil that had focused on reducing poverty by distributing benefits through an electronic payment card, and they have been credited to have contributed about 12 to 18% of reduction in poverty through this platform, a very significant platform in addressing that. Some of the other ones to highlight in Jordan with the Zero Hunger SDG, we see this fintech which is used by humanitarian financial aid donors for Syrian conflict victims by digitally registering the refugees with iPay, an application released by the company IrisGuard, and it operates using blockchain technology to support financial inclusion of the refugees in Jordan by processing their supermarket and ATM transactions in real time. So similarly, we've highlighted the other examples in the report as a reference for Islamic fintech. If we go on to the next slide, there are about 12 or so of the SDG goals that we have mapped to financial inclusion related fintech globally that are there, and a few more are highlighted on this slide. So if we can move on to the next slide. So when we talk about comparing financial inclusion benchmark within OIC countries, and the report looks at the comparison of high-income countries versus OIC countries. And we can see that the important point of the role of religion, which has also been highlighted earlier, but further highlighted in this report, that compared to the high-income countries for age 15 plus, the percentage of not having accounts or unbanked because of religious reasons is high, and hence the importance of Islamic finance and fintech to play the role. And like I said, the combination of this factor plus a very young population amongst the core Islamic finance markets makes fintech a key enabler for further addressing this gap. And so if you move on to the next slide. In the report, we highlight as well the mapping of how Islamic fintech can potentially address the barriers that have been highlighted through various surveys out in terms of the reasons for being unbanked, and as the solutions that Islamic fintech can provide in, for example, addressing the lack of trust in the financial system, the obvious one of religious reason, and especially working with the younger population that is increasingly part of the unbanked as well. This is a mechanism to address that gap. Next slide, please. In the report, we also cover 4 case studies when it comes to Islamic fintech and Islamic social finance, which is obviously a key, a big component of financial inclusion. The first case study here highlighted is of Blossom Finance, which is a Sharia-compliant microfinancing business that was established in the US and offers Bitcoin-based riba-free microfinance to US Muslim community to start off with, and had moved to Indonesia to be close in proximity to access potentially one of the largest market. And so it is a Sharia-compliant microfinancing business that has issued the first blockchain-based sukuk. The other one is a US-based crowdfunding platform called LaunchGood, Its founding principles is belief that Muslims value should be shared with the world, and it addresses crowdfunding for social projects around the world. And I believe as of last year, they had raised more than $100 million already through this platform. So one of the success stories that is out there and highlighted in the report when it comes to Islamic social finance. Finally, the report, if we can move on to the next slide, had identified three major areas of opportunity that Islamic finance or fintech can address. Number one, its potential in helping leapfrog Islamic financial services' own reach and impact. So catering to the digital demographic, leveraging the core technologies highlighted in the beginning of the report on artificial intelligence, data analytics, P2P lending, trade financing, InsurTech, as well as incumbents and startups and technology companies collaborating, which is part of how global fintech is developing, as well as providing open banking architectures. So these are areas that Islamic fintech, first of all, can help leapfrog Islamic finance's general reach, which also is part of the equation of financial inclusion. Second, in addressing significant financial inclusion gaps, specifically within the core markets. So SME and unbanked retail solutions, payment solution innovations, enabling access to the unbanked in remote areas, whereby even in many of the OIC countries, much like many of the countries that have been underdeveloped, that have more mobile payment access versus a smartphone access. So looking at those solutions. And then finally, delivering Islamic social financing to support global SDG and needs. This is an area, as highlighted in the report, still there's a huge gap in the availability and solutions that Islamic fintech is addressing today. So Islamic fintech delivering the wider global social needs, or SDGs, is the third area. The report concludes by highlighting some challenges that also exist related to regulations, investments, payment gateway regulations in particular, amongst other that need to be overcome. So with this, I'll conclude and pass the floor to Yomi yourself, and look forward to a good discussion. Thank you.
Thank you, Rafi. Very, very concise and illuminating summary of the report and what it found. Although I was part of the team that worked on this report, I was particularly fascinated by how Islamic fintech had grown so fast in such a short period of time. And things like the use of blockchain to enhance financial inclusion for refugees was just something out of this world for someone like me who is not as technologically savvy. Even though I have worked on this topic for a while, I still found that really, really dramatic the way blockchain was used to support refugees in Syria. But you also point out the challenges that Islamic fintech still faces. But this on top of challenges that Islamic finance by itself also faces. And personally, I think one way that this segment is going to evolve is teaming up with the traditional financial institutions, so that we don't have that demarcation between pure fintech and the traditional bricks and mortar financial institutions. We are beginning to see the blurring of the lines between those two. Let's now go to Dr. Rifki, who's our final speaker, a former regulator, but is now Assistant Secretary General with the IFSB, but regulators are always regulators. Dr. Rifki, usually people are bashing regulators for not creating an enabling environment, but tonight, everybody I've heard have said nice things about regulators. So let's go to you now and hear from your perspective. What do you think regulators can do more to enhance Islamic financing? Go ahead, Dr.
Okay, thank you, Mr. Abayomi. Excellency Tuan Muhammad Sahar, also Datuk and Dr. Bello, and my fellow panelists. Thank you so much. It's my pleasure and FSB pleasure to be in the event and to share with you some of our thought on the idea of Islamic financial inclusion. With regard to the role of regulators in financial inclusion, I would refer to our technical notes number 3 issued in December 2019 by the FSB. So first of all, financial inclusion is now a priority among global policymakers and financial sector regulators, particularly G20 countries. And also it is part of the pillars of the Global Development Agenda, including the SDGs. Interestingly, if we take a look at the Basel Committee survey among 52 countries, they have found that 36 of them have had a national financial inclusion strategy, also financial microfinance strategy. So financial inclusion is not the idea of the Islamic financial institution, but almost all of the international financial body. If I mention one of them would be Financial Stability Board with their authorities or members like CPMI, FATF, AIDI, IAIS, and others. So very standard setting of financial inclusion. Okay, FSB, we have issued financial inclusion in the technical notes number 3 to be referred by the regulators. The aims of our technical notes are first to provide international benchmark guidelines on regulatory and supervisory policies. Secondly, to provide guidance to RSA on the application of the proportionality principle so that the benefit of the regulation and supervision can be balanced against the risk and costs. Thirdly, to factor in recent developments in enhancing financial inclusion through the Sharia compliant mechanism, and then to consider a modality for the integration of modes of Islamic finance. And then the last but not the least is to highlight challenges and propose solution with regard to financial inclusion activities. If you may go, okay, this slide, please. With regard to the primary issues of the technical notes, the first, we define financial inclusions as a state where individuals and business in a society have access to and usage of a range of affordable and quality Sharia compliant financial products and services that appropriately and justly meet their needs and are delivered by formal financial services providers in a transparent and simple manner while duly complying with the rules of Sharia. And then we realize also that financial inclusion in Islamic perspective involve some sort of Islamic specificities. Yeah. First, Sharia requires contracts to be free from riba and also major gharar, maisir, and other prohibited activities. Also in Sharia, there are also Sharia compliant contracts applied commonly in world of Islam, ijarah, salam, mudarabah, musyarakah, and hybrid contracts. Also, in applying the financial inclusion, we state in the standard that the application should involve the supervision by the qualified expert, including the Sharia scholars or Sharia board. Yeah. And another important point that the regulator should apply and should construct the regulatory and supervisory guidelines to clarify the need of Sharia review and audit of the Islamic financial inclusion. And we also don't need to remember that in Islamic finance there are also a particular contract that enable a donation or grants, or we call it Islamic social funds or finance, such as sadaqah, waqf, zakat, and so on. Yeah. As a method, we identify a number of methods. Yeah, they are currently being used by different regulators in the world to introduce a proportionality in the regulatory regime. And in the standard, we identify first the categorization approach, which involves establishing a categories of institutions according to different qualitative and or quantitative characteristic. And then secondly, specific standard approach, which involves establishing tailored criteria for the application of specific requirements. And then we also remind in the technical notes that the presence of the several authorities having a mandate or a supervisory responsibility in financial inclusion should require the interagency coordination mechanism. So financial inclusion might involve various authorities such as Ministry of Cooperative and even sometimes Central Bank or Ministry of Finance. So they need to have interagency coordination mechanism. And also as also mentioned by the previous speakers, digital financial inclusion is also very important. But we need to bear in mind that digital financial inclusion may invite some of the potential set of operational, settlement, liquidity, credit, consumer protection, and money laundering risk. So as long as we can identify these kind of risks and set of some mitigation, hopefully digitalization can further support the financial inclusion activities. With regard to financing activities, the standard identify that in Islamic we can use microfinance loans or microfinance financing in this case with various contract in Islamic financial contract, yeah, for working capital and for other means of financing. But we remind regulators to conduct prudential regulation, particularly the risk management framework, capital requirement, financing limit, provisioning, and so on. With regard to supervision, we also put in the standard that supervision of these activities require appropriate knowledge of the service providers, business methods, and operation by the. With regard to the deposit activities, yeah, we put in the standard that there are current accounts in Islamic, yeah, based on card that can be adopted. Also, some of the term deposit products with the structure of commodity murabaha, for example, or equity-based deposit activities. But again, in this side, we also leave some of the notes that the regulator should provide or should be aware of the emergent liquidity funding to mitigate the risk, and internal reserve fund or deposit insurance protection, just to secure the deposit activities for financial inclusion. And then with regard to investment activities, it may take a variety of forms and mechanisms in Islamic, including, for example, equity participation, a partnership-based agreement, or agency-based agreement. And then with regard to the contract, of course, we all know that the Islamic finance provide like Sharia compliance contract for investment, such as Mudharaba, Musharaka, and Wakala. But again, similar to the deposit side, we also address the issue of risk management framework, capital requirement, investment limits, exit plan and redemption, losses and liquidity arrangement, and credit enhancement mechanism, just to secure the position of Islamic financial providers. Also, in our standard, we also put the non-prudential regulation. It captures the operation of service provider with the overarching objective of protecting the consumer and maintaining the integrity of the financial system. Last but not the least is the Islamic social finance, as addressed by the previous speakers, also by the keynote address. Social solidarity instrument like court, sadaqah, waqaf, and so on are also very important in applying the financial inclusion. Next, please. If the previous speaker gave the example of the, in this case, I would like to give an example of the Indonesian case for the sake of implementing the financial inclusion. In Indonesia, we also have the National Financial Inclusion Framework. There, the objective would be to achieve economic welfare, to poverty alleviation, equal income distribution, and financial system stability. And with the several impacts expected from the program, first, to have the equal income distribution, poverty alleviation, and financial system stability. Who are the target? The target of the financial inclusion are migrants, workers, and people in remote areas. Particularly, those are very poor, working or productive poor, near poor, and non-poor. What are the programs implemented in Indonesia? They have public finance information, supporting policy, regulation, intermediary facility, and consumer protection. One of the examples would be in Indonesia, we have had some of the banks and financial or non-bank financial institutions extending financing to the SME for the sake of financial inclusion. One of the examples would be most of the Islamic banks and Islamic banking windows there around 50% or above financing extended to the SME. Also, they have some of the Islamic non-banks financial institutions such as BMT, Baitul Mal wa Tamwil, microfinancing, even nano financing. Also, they have what they call Islamic rural banks. Yeah, this is the special bank operated in certain province or municipal. So they have nearly 200 Islamic rural banks, and these kind of banks and non-bank financial institution totally extend financing for the SME and for the non-bank, including the low-income people. Another unique thing applied there would be the application of the Qadrul Hasan, yeah, and also Islamic social finance. And there have been two institutions similar like the one in Malaysia, specializing in Islamic social funds. First is the National Amil Zakat, or we call it Banas, and also National Body for Awqaf, we call it BWI. So there are two national bodies specializing in managing the Islamic social funds. And with the coordination also as also being addressed in the standard, the Ministry of Finance and the National Awqaf Body, Ministry of Regulation, Ministry of Religion and Bank Indonesia have initiated the first sukuk that they call it Cash Awqaf Link Sukuk. It is the first Indonesian government sukuk having the social akad, yeah, we call it awqaf, intended for establishing the social infrastructure project. So it is amounted around 5 million US dollar, and they are going to issue the second batch of this awqaf, sukuk awqaf of the Indonesian. Also, with regard to digital finance, one of the example would be the crowdfunding. There are nearly 200 fintech company, and one of the biggest crowdfunding company collected 1 billion US dollar social fund from the public. Also, these are some of the examples from Indonesia. Thank you so much, Mr. Abayomi.
Thank you very much, Dr. Rifki, particularly for highlighting how IFSB has done so much work to provide the standards and guidance to regulators on the ground in terms of how to oversee Islamic finance in general and Islamic financial inclusion in particular. And thanks also for sharing lessons from Indonesia in terms of the framework for Islamic financial inclusion. I think this is also very useful for me and for the participants as well. Now that we've heard from all three speakers, we've been getting questions from the audience. So we're going to go straight to questions and answers and discussion. And I'd like to use my prerogative as the moderator to ask the first set of questions, if you don't mind. And in the meantime, I'm trying to pull together some of the questions we are getting online from the audience. But the first question I would like to pose is to my good friend Amir. You heard Dr. Gafoor talk about how Islamic finance need to be value-oriented and impact-focused. What do you think Islamic finance stakeholders can do to ensure that this continues to be the case? Because this is really the core of what we've been saying about Islamic finance.
Absolutely. Well, thank you so much, Yomi, for the question. And, I've been very excited and encouraged to see the eagerness with which Islamic finance, the SDGs, the Sustainable Development Goals, and the notion of impact measurement and tracking. And so, one of the good examples of this, of course, is the recent SDG Sukuk issued by the Islamic Development Bank. And what we've seen consistently as we've engaged with Islamic finance stakeholders is that they've embraced these SDGs, they recognize the importance of them, and they incorporate them into their assessments. So I think that's one very important way. For the industry to thrive, it is important that it be appealing not only to religious sensibilities, but also to the social impact that would underlie people's motivations to choose a non-conventional source or means of financing. So I think that's one. One is kind of commitment to the SDGs, to social impact metrics, to measuring and communicating that. That's more broadly. With respect to social finance, as has been discussed throughout this the session today, it's very encouraging again to see social finance actors measuring their impact. And Indonesia has been discussed by Dr. Rifki, and certainly Basnas is a clear leader in their commitment to align all of their projects. So they have a 3-phase journey that they're on to align all of their zakat distribution with specific SDGs and measure that. So I think that that's one way that would be very useful, is to keep that tracking going. And then of course also, you know, from a policy perspective, it is important that regulators provide choice to consumers in terms of which forms of finance they want. And I certainly would believe that competition is healthy and competition is helpful. So as the basis of competition becomes more sophisticated, I believe that differentiation on impact will become more central.
Thank you, Amir. Now let's go to Rafi. You also heard Rafi during the keynote speeches that even though we are talking about how COVID has increased the potential for digital financial services, we still have a lot of people who are not digitally savvy, or people who live in areas with poor connectivity. So what do you think could be done to reach these people who are still like in the doldrums when it comes to the use and reach of Islamic fintech, or even fintech in general?
Thank you, Yomi. As highlighted in the fintech Islamic fintech report, the fact that the core markets of Islamic finance have a very young population, and relative to rest of the world have very high digital penetration when it comes to internet access. Relatively, again, when we look at even countries such as Indonesia, the largest population of Muslims in the world, but the internet penetration vis-a-vis global benchmarks is quite high. And the population is young in general when we look at the core markets of Islamic finance. So first of all, there is fintech as a proposition already has a good fit with the Islamic finance core markets. However, like you said, there still remains major gaps, not just as shown with the data, not just in financial inclusion, but definitely fintech's role also in it. So fintech is certainly showing the opportunity for the Islamic financial institutions to both meet and address the gap as an opportunity to reach the long tail of Islamic financial customers and offerings. So the long tail meaning the small businesses or mid-sized businesses, as well as the retail long tail. Whereas it may be high cost to deal with retail customers in conventional way or traditional way, digital gives you the business case to engage with the wider retail market at a lower cost per customer. So first of all, I think the financial institution in Islamic finance who are much more risk averse have to look at this as an opportunity to further make the push and investments on realizing that this will help grow the business in general by reaching the smaller markets, as I said, the longer tail of the Islamic finance markets, both retail and business side. Secondly, in the global benchmarking of or global examples of fintech, financial literacy, fintech solutions are also becoming very prominent. And from a business case to Islamic financial institutions, again, they have to see this as an opportunity to build loyal customer base for the future. If they're able to provide financial literacy, and fintech solutions again are prominent examples worldwide where, for example, having parents engage with young kids, high school kids, on teaching them on how to do saving, spending on charity, and so forth. Again, these are tools that fintech can offer Islamic financial institutions to further build that base or widen the base. So, and then finally, of course, at government level, especially when we look at from a financial inclusion markets, some of the least developed countries in the world are comprised or part of OIC countries. In sub-Saharan Africa, in parts of Asia, even parts of Central Asia, and so forth. So the basic infrastructure push at the government level has to happen. But again, with examples such as M-Pesa that we all know about in Kenya and others, again, that push to skip the technological steps and go straight to the rural areas and customers through the various options that fintech provides. So I think these would be a few areas that I would highlight that would help further bridge the gap. But as a natural proposition, the Islamic finance market already, the core customer base is already very young, digital savvy, and it should be a good impetus.
Thank you, Rafi. Dr. Rifki, we're all interested in expanding Islamic finance inclusion, or Islamic financial inclusion. But we also know that not all financial institutions behave well. There are possibilities that you may have risky behavior as a result of Islamic financial institutions trying to expand their balance sheets. And there are also issues with customer protection and consumer protection in general. So one question I had in mind for you is, as a regulator and a standard setter, how do you think we can strike a better balance between promoting Islamic financial inclusion and ensuring that there is attention to consumer protection as well as the safety and soundness of financial institutions?
Okay, thank you, Mr. Abayomi. For that question, I would like to suggest also our technical notes to apply the prudential and non-prudential standard. Yeah, as we realize that extending finance for like unbankable people, low-income people, or less access to financial system people, they are usually having no collateral, also lack of governance, like lack of auditing, lack of accounting, and so on. So as also mentioned by you, it's very challenging for Islamic financial institution, even for conventional financial institution, to do financial inclusion. So what can they do to have a prudential kind of system? First, they need to have a strong and robust risk management. First, for the financial institution, they need to apply a recommended Islamic finance scheme or contract, also stated in the technical notes. Yeah, instead of applying like commercial kind of Islamic finance and other commercial contract, they also apply the social one, like Qardul Hasan, including the Sadaqah, Infaq, Zakat. Yeah. And then secondly, they need to have a strong supervisory, not only by one regulators, but by all related regulators. Also stipulated in the technical notes, they need to have inter-regulatory supervision, because financial inclusion may engage some authorities altogether. Yeah. Also liquid market and also governance. Yeah. This is very important. Also governance, like the case of, I believe also not only in Indonesia, but also in Malaysia and other Muslim countries, we need to have a standard for accounting, standard for auditing, standard for supervisory. For the case of Indonesia, as I know, they have finished issuing the standard for zakah accounting, also standard for awqaf accounting. So these are very important to ensure the governance of the inclusion activities. Yeah, and then last but not the least is the question, the bumper for applying the financial inclusion, which is the application of Islamic social funds. To be honest, I myself have heard, in one of the presentation by the Islamic Rural Banks, that they did extending the Qardul Hasan. Yeah, so they extended money financing for like less than $10 for many financial SMEs in the regions. And then when there is a crisis, and then they just give it as a free loan. Yeah, so they don't need to repay, and even enhance the SME by extending a new financing just to improve or just to give some sort of new liquidity for them to start having a new kind of business? Thank you.
Right. Thank you, Dr. Rifki. The questions are pouring in, and I'm trying to group them somehow. But there is a question which is a general question to all the speakers, which is Islamic finance is addressing this issue of financial exclusion due to religious reasons. What do you have to say about people who are still excluded from Islamic financial services because they are not convinced about the Sharia compliance of current financial institutions and financial products, Islamic financial products? So who is the brave person to take on this question? What are your views about people who still exclude themselves because they don't trust the Islamic financial institutions?
Sure. Well, thanks, Yomi. Let me refer to some of the data that we have on financial exclusion due to religious reasons. So one of the points, as I mentioned, was that there are people who are not Muslim who exclude themselves for religious reasons, and that itself, I think, is very noteworthy. And so, for example, in the context of Malaysia, the 1.6% of the population, I'm not sure to what extent we can say certainly it's Islamic religious motivation or other faith traditions that's keeping them out of the system. That being said, from a sort of anecdotally or qualitatively, what's important, we've seen success in bringing people into the financial system have been where there are concerted efforts around religious Sharia governance to take those concerns head on and make them known. What I would be curious to look at from a policy perspective is how do the national governance boards, Sharia governance boards, link down to the local community level? And to what extent do local religious leaders plug into, understand, convey, and speak to the national positions that have been taken on financial participation? Because that could be possibly where the gap lies between, there may be at the federal level, some clarity, but less so at the local level.
Any other comments? Rafi, Dr. Rifki? Any
Sure,
views
if I can.
on whether Islamic financial institutions are Sharia compliant and whether that deters potential customers?
Sure. If I can add to Amir's points, one of the things that has been a continuing challenge within Islamic finance, especially on the retail side, has been this question of credibility, this question of retail side people questioning the authenticity of Islamic finance in general, and in a way excluding themselves because of them questioning the relevance of Islamic finance. And one of the things we're seeing when we look at the Islamic fintech developments is that a lot of Islamic social finance as fintechs are really taking off, from crowdfunding for social projects to zakat platforms to sadaqah platforms, and perhaps something for Islamic finance to really, as Islamic banks to look at, is the customer base that's attracted to the wider social appeal of Islamic finance. As we know, the underlying thesis has a strong social impact or basis of ethics, and it's been talked about within the industry for a long time now that Islamic finance should be going to the roots of its purpose, or maqasid al-Sharia, and so the today Islamic fintech in some ways is showing the way. And we see a big customer base, for example, in these social finance platform that's coming online, leveraging these Islamic fintech platforms for Islamic social finance, who may not be Islamic finance customers per se. So I think there's a widening of Islamic finance's positioning and proposition to this core customer base that includes social finance or their ethical impact credentials. And perhaps that could be another piece of the equation to contribute here.
Yes, if I may, Mr.
Yes, please.
Bayomi. Yes, this is the one that when we socialize Islamic finance to the stakeholder, we mentioned that Islamic finance is for all. This is for the rich, yeah, for the needy, for the religion. Yeah, it doesn't matter that they are Muslim, non-Muslim, but Islamic finance is the system for all. There's also the existence of the Prophet. Yeah, he's for rahmatan lil alamin, for the sake of the whole. Yeah, and even when we check the account in Islamic bank, we seldomly find depositors of them are non-Muslims. And also, one of the interesting example, if I may share with you, the utilization of the Awqaf fund, yeah, in the instrument called Cash Awqaf Link Sukuk I mentioned before, it is for establishing or for building the hospital or for the poor. So this hospital is for free for anybody, whatever the religion, whatever the ethnic groups, whatever the background, they can just come and will be tackled, will be professionally cured by the professional doctors. So this awqaf is now being used for establishing the hospital for all the people. Yeah, it's under awqaf. Also, we do need to realize that also the potential of sadaqah. Yeah, of course, zakah is only for Muslim, but other Islamic social finance are for all. Yeah, for sadaqah can also be extended for the non-Muslim as long as it gives the benefit for the people. Thank you.
Thank you, Dr. Rifki. We have some questions that are addressed to specific speakers. Rafi, I think the first one is for you. And this one says, what do you see as the impact of COVID on Islamic fintech? And will this change some of the key findings from the report as you've outlined?
Sure, thank you, Yomi. We, in fact, in early in May, had produced an analysis of the impact of COVID-19 on Islamic finance in OIC countries, in coordination with CAN EKS in Indonesia, with various contributors from around 12 OIC countries that represent 87% of Islamic finance assets. So we did an assessment of how Islamic finance has been hit or affected by COVID-19. And when we talk about fintech, Yomi and all, as you can imagine, fintech is not a separate, it's all part of the overall economic context of the countries or jurisdictions where Islamic fintech is active, as well as the specifically Islamic finance. The impact on Islamic finance also has obviously a direct implication to Islamic fintech. So when we looked at these 12 major OIC countries, as I said, that represent 87% of the OIC. First of all, when we look at IMF's projection of GDP growth coming back in 2021, we benchmarked and we saw that most of these OIC countries' GDP growth projection for 2021, first about the drop in 2020 was significantly, they're all obviously mostly in negative, with some of the countries such as Bangladesh and Indonesia, in fact, ending 2020 as per IMF April 2020 projections at 2% growth in Bangladesh versus 7.2% in 2020. Indonesia 0.5 versus 5.1 projected earlier for Indonesia as a GDP growth for that year. Versus in US, we were looking at a 6% drop in GDP, or Germany 7% drop, but also other markets like China showing a 1.2 increase. So in general, we saw an average, many of the OIC countries faring relatively well as an overall economy. And then we looked at the stock exchanges within OIC countries in terms of their 5-month average between December 2019 and April 2020. And again, we saw the 5-month average, and for example, in Jakarta, it was 0.27 as a 5-month, versus New York Stock Exchange or Shanghai, which was negative 0.2, versus New York Stock Exchange at 0.2. So again, relatively faring well in some of the big markets. Specifically in Sukuk, we saw S&P ratings projected Sukuk issuance was expected to drop in 2020 to $100 billion of Sukuk issuance as per S&P, versus $162 billion in 2019. So overall issuance certainly dropping as per S&P. However, we saw the Sukuk index returns actually coming back very strongly in April versus March of this past year, when there was a big drop. So certainly the returns were returning as the markets, I think, have absorbed are reflecting the general projection now that 2021 will be the year of return. A last data point from that analysis, when we looked at the equity indexes, again, the S&P Global BMI, with the COVID-19 taking center stage, global equities in 2020 fell by 22%. This is as per the S&P Global BMI, versus BMI Sharia, however, outperformed it and it dropped 17%. So there was a relative better performance. Similarly, Dow Jones Islamic markets, Europe and emerging markets each outperformed their conventional benchmarks by more than 8%. So to summarize, I think the wider macroeconomic and economic impact of Islamic finance and the economies that Islamic finance is playing will obviously have a direct relation or impact on Islamic fintech. Having said that, Islamic fintech is also the tools and mechanism to override some of these challenges, as being also seen. So these are some of the initial thinking that we have seen in terms of the impact of COVID-19.
Thank you, Rafi. Thank you. Amir, let me come back to you. There's a question on Malaysia's accomplishments on Islamic financial inclusion. And the question is, Malaysia seems to have done a lot of things well. So are there any areas where Malaysia did not do as well and can learn from other countries? You're muted, Amir.
Thank you. Well, thank you for the question. And I see also from the same questioner a point regarding social finance. And if you permit, maybe I can take them both in the same response. So to clarify the comments I made regarding the social finance governance, Malaysia indeed has a state system. And what I was commending was the steps taken by Securities Commission Malaysia, and before that by the federal government, to try to create some harmonization and to support the states in the area, because yes, that has been one of the critiques of Islamic social finance development, has been the fragmented governance, and they may not necessarily be adopting best practices. So the role, the leadership taken by the federal government in that is what I would highlight as being a good step, as well as the Securities Commission innovation in introducing including Awqaf assets in their purview for financing sustainable development. So I think that's a clarification to respond to the questioner's concern. With respect to what could be done for financial inclusion more broadly, I talked about 3 different areas. One was the policy, the second were the institutions, and the third was the coordination amongst the various the bodies. And I think what's important here is that, for instance, with Tabung Haji, you'll notice from the data that Tabung Haji has provided strong returns for its depositors, but the data you'll see in the report talks about how that was not always the case. So the idea of earlier on having the institutions that provide inclusion be competitive with those that are conventional is very important. So I would say that the competitiveness of the inclusive institutions from an economic perspective is one area where there was room for improvement, and certainly the later data shows that those improvements did take place. So I think that's one thing that Malaysia, a lesson that Malaysia learned along the way. And when we look at other countries that have been successful with financial inclusion, there are also steps that they can take for encouraging more individual home account ownership. So the data that we see in Findex talked about how there are, when we look at the 15% in Malaysia who are not don't have accounts, some of them reasons that they cite include that they're in large households where there's one person with an account and others don't have it. So encouraging or highlighting the benefits of individual asset ownership, particularly with regards to gender, would be very useful. So I think one thing that could be done would be to promote and to emphasize to the population, but especially to women, that having individual accounts is beneficial, protective for them economically and socially. That would be one area that I think could be further built on.
Thank you. Rafi, there's a question for you on how Islamic fintech can cooperate more with traditional financial institutions to expand or to strengthen financial literacy. You had made a comment about there's this increasing cooperation. So in the area of financial literacy or even digital financial literacy, what do you think could be done more between those two sides?
Absolutely. And Yumi, you had also highlighted as we were developing the report that there is now blurring of the lines between startup, pure play fintechs, conventional financial institutions, and most certainly now the shift in financial services to even beyond financial institutions. Today we consider tech startups like Uber and Grab and so forth, actually financial services players also with their payment platform, so forth. So the space is truly being disrupted, and it behooves both certainly the incumbent financial institutions to really be investing in the in context of long-term engagement with the future customer base. In specific to this one area amongst many others, because this is a very broad question, Yomi. You could obviously, as you can imagine, it's there are many aspects to how this cooperation can further be strengthened. There's obviously a lot happening, as highlighted in our report, within various Islamic finance jurisdictions, with the sandboxes and the regulations supporting and initiatives such as here in Malaysia, MDEC, a strong focus now on Islamic fintech as well. But one of the areas I would highlight for Islamic fintechs, because that's the specific question on how can they cooperate with Islamic banks, is to also make a strong business case for such financial, including longer term solutions, because ultimately banks have strong fiduciary responsibilities and have a strong risk averseness and looking at financial returns. And so for fintechs to really make the business case going in, and I give the example of when we talked about financial literacy, because that's part of the question, that there are now various fintechs around the world where banks as well are seeing financial literacy as a means to build long-term loyal customers. So when you have financial literacy that you start as a program, as a bank, working with a fintech that has perhaps good solution out there, already has some traction in the market, for them to sort of create this future customer base, or also loyalty with a family as a customer base. So I think for fintechs to really look at the business case and make it a strong business case, and obviously a strong proposition to engage with financial institutions that have. Now it's quite clear that the incumbent financial institutions have very strong relevance for fintech, because they for the market, Mr. Rifki highlighted the concerns around consumer protection as part of fintech growth and other cybersecurity concerns, so forth. So a conventional bank, provides that solid infrastructure and reputation that fintechs have to work with and leverage. So the win-win is there, and these are some of the areas that perhaps could be focused on.
Thank you, Rafi. And with that, let me once again thank all the speakers and bring this discussion to a close. I apologize to those whose questions could not be answered. In the interest of time, we just do not have the space to answer all questions, but please, we value your participation and we've taken note of your questions and we'll pass it along to the speakers. And we do have your contact information in some cases, and we will respond to you as soon as possible. So once again, thank you, everybody. And back to you now, Rosani in Kuala Lumpur. Rosani?
Thank you very much, Yomi. I would like to thank all three panelists today, Amir, Rafi, and Dr. Rifki, as well as Yomi yourself. And for all our attendees, I would like to draw your attention to the short poll that we are having. We would really appreciate if you could respond to this poll, as it provides feedback for us for our future events. And with that, I would like to thank all of you for joining us today. We also have the QR code links to both reports on screen right now. Thank you very much.
Thank you. Bye-bye.
Thank you.
Thank you. Thank you, Mr. Abayomi and colleagues.
Thank you. Bye.
Thank you very much. So long. Thank you.
Record boleh stop.